Great. Thank you everyone for being here today. I did go ahead and mute all participants, but I also do encourage questions. So please feel free to use the chat box, or you can raise your hand, unmute yourself if you have any questions. Definitely welcome that. So today, I'll be giving a presentation based on The Millionaire Real Estate Investor, which is a book by Gary Keller, who is the founder of Keller Williams Realty. And I'm also joined by a special guest, Adriana Moschella, who is joining us from Eastern Bank, and she is an expert in commercial lending. So thank you, Adriana, for being here.
Thank you for having me.
You're welcome. And so let's get started. Some legal stuff from Keller Williams, basically saying that you don't automatically become a millionaire, but this is some really helpful foundational information to help you get started in real estate investing. And I want to just quickly introduce myself in case you don't know me yet. Of course, I'm a licensed realtor with Keller Williams Realty. I've been in real estate since about 2010 in the greater Boston area. I come from a film and TV background. I lived in LA for 4 years and worked as a talent agent for a talent agent in Beverly Hills. And then basically just I was introduced to real estate investing by my father, who really had a lot of success with it. And I read the book Rich Dad, Poor Dad, and figured out this was the way to go rather than trading my time for money, to build value and build wealth through real estate. So I've been with Keller Williams for about 6 or 7 years now. Time flies, and I'm also an investor myself. I've got experience in flipping homes, long-term buy and hold, house hacking, wholesaling, you name it, I've kind of tried it all. But today's presentation will focus on the buy and hold method. It's the best tried and true strategy of wealth building in real estate, and I really believe in it. So we're going to talk about that today for the most part. And I also have published a book called You Can Have It All with Real Estate, which is available on Amazon. And it's based on my experiences as a realtor and as an investor. And it's basically just to help people get started in investing in real estate, because I really firmly believe that everyone can do it and everyone should. So again, it's based on this book. You can order this book yourself. It's more or less a manual, a very thorough and detailed manual for wealth building in real estate investing. And just to share with you quickly, the reason I am so passionate about this topic is because I believe that financial freedom can empower people to really fulfill their purpose in life with, having passive income and not having to struggle to pay the bills. That opens people up to a lot more possibility. And so today, what we are primarily going to cover are first some myth understandings, as Keller Williams calls them, Gary Keller calls them, of why people don't or are scared of investing in real estate. We're going to bust those. We'll touch on the current market, your big why. We'll talk about the power of leverage, which is a crucial element in why real estate investing is so powerful. And we'll also touch on the proven systems and models of how to make sure that you're following the path of success that so many other people have laid out before us, and using those time-tested models to create your own wealth. Okay. So wealth, financial wealth, the unearned income to finance your life mission without having to work. So that's kind of what we're talking about here with the buy and hold method. It's passive income. It may not feel like it right away, but it's, it's not a get rich quick scheme, but over time, it's going to lay a foundation for financial security and even financial independence. Let's talk about those myth understandings that I mentioned. And, you know, there is a lot of fear that comes around real estate investing. I encountered it all the time. So I want to encourage you to take a look at these and see if any of these myths resonate with you, if any of these are holding you back. The first one, just simply, I don't need to be an investor because I have a well-paying job and that will take care of me. But the fact is, your job, your income is actually not your wealth. We've all heard of, top paid athletes that have squandered their money and ended up broke, for example, right? Or, think about Bill Gates, one of the richest men in the world. His wealth is actually not his income, it's his net worth. So the question is, what are you building? Is your net worth growing over time, or is it shrinking? That's really what defines your wealth. Myth number 2, I don't want to be financially wealthy. I'm happy with what I have. And that is awesome if that's where you're coming from. And yet, we never know what's going to happen. And COVID really proved that point. Anything can happen. Economies can go up and down, natural disasters, pandemics, family emergencies. And in order to be in a secure, stable place for the future, it's important to think about your financial health. It's important to think about building your wealth so that you can help yourself, your family, and others that might need it. Myth number 3, it doesn't matter if I want or need it, I just can't do it. Well, that's obviously a limiting belief. Of course you can. I mean, there's so many rags to riches stories in real estate, it's ridiculous. Some of the first real estate millionaires were immigrants who came here with nothing and built an empire from real estate. So you definitely can do it. What about this one? Investing is complicated. And sometimes it seems like it is. There's a lot of information out there, but honestly, the models we're looking at are pretty simple and the strategies are pretty straightforward. And again, they're time tested. So investing is only as complicated as you make it. It's a highly repeatable model. Similarly, the best investments require knowledge that most people don't have. You know what? Real estate is something most people have an inherent intuitive sense of because we all live in homes. So it is something you can grasp pretty easily and with just some common sense and maybe some simple tips and tricks that you can easily learn. And then investing is risky. I'll lose my money. Honestly, it's crazy to even hear this to me because investing by definition is not risky, and it's more risky not to invest. I mean, we're all hearing about inflation, cash losing its value over time. So if you're not investing, you're losing money by definition. Successful investors are able to time the market. Another one I'm hearing a lot lately because the market has been crazy and it's a seller's market. The thing about it is you can't time the market. If we could, we'd all be millionaires already. But in successful investors investing, the timing finds you. So as long as the numbers work and you can make a cash flow or you can see a profit, then it's a good time to invest. And lastly, all the good investments are taken, but every market has its share of good investments. And we'll talk a little bit more about that later. So about the market, we know, I'm sure you know if you're paying attention to real estate at all, that the rate of appreciation has been very high. It's been unpredictably crazy during COVID. I mean, who would have thought that we'd see double-digit appreciation during a worldwide pandemic? And yet that's what's happened over the past 2 years. Going into this year, we're a couple months in now, experts predicted that the rate of appreciation would level off. So we'd still see a strong seller's market, but it wouldn't be at such a rapid rate of appreciation and more of a balanced market. So we're kind of seeing that, although appreciation is definitely toward the higher end of the spectrum on this graph. We're definitely more like to the 5 to 7 compared to last year. But it does depend on what kind of property you're looking at. These are just averages, and of course, where you're looking at them. So all this to say, the market's still going up. And if you're waiting for the market to go down, you're probably going to be waiting for quite some time, because it's not likely that we'll see a crash, simply because the inventory is so low and the demand is so high. And also, most people have a lot of equity in their home right now. And so a big wave of foreclosures is very unlikely. And that's, of course, what caused the crash back in 2007. So we're not seeing those same kind of indicators that we saw back then. So it is a great market for selling, but it's still a great market for buying as well, because the market's going up. All right, so it's important, and Gary Keller talks about this in the book, it's important to know what your big why is. Like, why are you doing this? Why do you want to invest or achieve financial freedom? Yeah, everyone wants more money, but it's important to really connect into why it's important to you. And I would encourage everyone, if you're not sure what your why is, to maybe do some journaling around this. That's what really helped me, is just writing about it, and then revisiting that a little while later, a couple days later, and seeing if there's any patterns, seeing if anything sticks out. And really feeling emotionally into that desire of what it is, because it's going to help pull you through to do the work that you need to do. And then from there, you can think about what your goals are. So if your big why, for example, is to be financially free so that, you can pursue a passion or start a business, or just have security for your family, then what are your goals that are going to allow you to do that? You can, if you want financial freedom, then you have to think about what your expenses are, right, on a monthly or yearly basis, and how much money do you need to cover those expenses so that you're no longer having to trade your time for money. And once you know that number, then you have measurable targets that you can shoot for. And the big models and the strategies that you're using can now be personalized and customized according to your goals. And then you just really need to know what are the things you need to do consistently to achieve those goals. Depending on what strategy you're using, it's going to then be broken down into a daily, weekly, monthly routine. And this is something I can help you with if you want help breaking things down from what you want and then to where you are now, and doing that kind of analysis. So talking about the power of leverage, this is so important because it is very unique to real estate, and it's very, very powerful. So we're going to look at a comparison of real estate investing versus investing in stocks or bonds. Just to illustrate, why real estate is so powerful and why it's repeatable too. So this table is showing you if somebody wanted to invest in $100,000 worth of either stocks, mutual funds, money market, or real estate, what would that look like? Well, for stocks, if you want to buy $100,000 worth of stocks, you need $100,000. It's a 1-to-1 ratio. Same goes for mutual funds, same goes for money market. But then for investment property, you only need a fraction of that in cash in order to invest in $100,000 of real estate. You would need, if you don't live there, you'd need 25%. If you live there and own or occupy one unit, for example, and rent out 1 or 2 other units, then you even need less money because you can use a different kind of loan. But let's go with the $25,000 for sake of this example. Okay. All right. So then your carrying costs for stocks and mutual funds, average out 1 to 4%, depending on the kind of product. For a money market, you really don't have a carrying cost. And for investment property, you do have carrying costs, but your costs, your expenses of ownership, are going to be offset by the income from the rent. That's the whole idea. Other costs, you have to factor in a vacancy rate and maintenance as well for your investment property. But again, that's going to be paid for out of the rent that you're collecting. And these other forms of investment don't have any other costs typically. And for income per year, so for stocks, a good average people like to use around 8% dividends per year. And for mutual funds, 10%. And money market's a pretty low risk, low return investment. So we're talking around 2%. For real estate, a good average over the last 100 years or so has been 5% appreciation year over year, that the market value is increasing. Now for other income, there's no other income for stocks, mutual funds, or money market, but for investment properties, you have your cash flow from your rent. So it's two ways that you're gaining value, the appreciation and the rent. So let's look at the return on investment, or ROI. The adjusted ROI for stocks is 4 to 7%, mutual funds 6 to 9%, money market 2%, and those numbers are just taking the income, the yearly income, and subtracting out the carrying costs. For an investment property, it's 20% in this example, and that's because you're putting down only $25,000 on the $100,000 purchase. So your 5% appreciation is now calculated on the purchase price, or excuse me, on the initial investment of $25,000, right? So you're actually seeing a 20% return on that $25,000 investment, which is the 5% appreciation, and that's not counting in any cash flow that you're getting from the rent. Potential loss, so the risk for stocks is the stock could go to a value of 0. We've seen that happen. Mutual funds, same, they can go to 0. And money market, again, it's a more stable investment, so there's not really that risk there. And for investment property, 40% is potential in a major downturn. It would never go to 0 because there's always this inherent value in the land. Land always has some kind of value. And again, if anyone has questions, feel free to jump in or raise your hand or use the chat box. And this is just, thank you, Cami, thank you. This is just another slide further explaining what we're just talking about. So the calculation, again, is 5% of $100,000 is $5,000, so that's your appreciation, and then $5,000 is 20% of your initial investment of $25,000. So I love this here where he says, to make the same money in a mutual fund yielding 10% with no costs, you need to come up with $250,000 cash. And that's a lot harder to come by than the $25,000 that you need to make the same investment or the same return in real estate. So that's the power of leverage. And this diagram is kind of just showing a wealth building mindset and what the difference is between an investor mindset and a consumer mindset. So investors know that their money works for them. So it's making money for them while they're sleeping. That's the whole idea of investing. Whereas a consumer mindset is built on consumption and cash. So a consumer will tend to get a paycheck and then spend what they can and save what's left over and maybe invest if they have anything left over after that. Whereas an investor will first take the money that they receive and reinvest it back into capital. And so that money continues to make money for them passively. And then whatever is left, they'll use for consumption and enjoyment. So it's kind of the reverse. So you definitely want to be in the investor category where your money is working for you. So financial model part 1, equity buildup. Now this is so important to understanding why buy and hold is so incredibly powerful. So when you first buy a property, you'd be over here on the left, you'd have mostly debt in the property because again, you only have to come up with a fraction of the cost of the home in order to control the asset and own that property. And then you're going to work with someone like Adriana, who's going to give you a mortgage and cover the rest. So you have, maybe 25% equity in the home and then 75% debt in the outset. But the magic happens over time. The market value increases. So two things are happening. The value of the property is increasing. We're talking, again, like 5% per year is the average historically. Past 2 years, it's been more than that. But yeah, it's going to increase over time. And in the meantime, your debt is also being paid down every month. And who's paying the debt down? It's the tenants, right? It's your rent is covering your, yeah, exactly. And so that's happening every month. It's chipping away at your principal. And those two things are happening at the same time so that at one point you actually have your debt completely paid off. And also your equity has built up. So you're sitting on this nice little nest egg. And you've had to only invest that initial down payment, but look how it's grown over time. So that's where the magic happens. It happens over 20, 30 years. That's why it's so important to get started early. And that, it's never too late. Don't get me wrong. It's never too late. But I like to talk to young people and have them get started thinking about this sooner rather than later. It's also never too early. And then financial model part 2 is your cash flow piece. So while your appreciation is happening, you're also getting the cash flow. And in the beginning, when you first buy an investment property, it may not be a huge cash flow, but you want something. You want something left over after you've paid the mortgage, the debt service, and any expenses. What's remaining is then your cash flow. And even if it's, say, I don't know, $100 a month in the beginning, that might be okay. I mean, it depends on your goals, but what's going to happen is just as the market value of the property is going to increase over time, so is the rent. Rents don't go down, they go up. And in the meantime, your debt service is, assuming you have a fixed payment, is going to remain the same. And typically expenses might fluctuate a bit, but on average, they're going to remain relatively stable as well. So your cash flow is going to increase every time you increase the rent, right? And then at one point, again, your mortgage will be paid off, and that'll be probably your biggest expense. So your cash flow will receive a big bump up, and you'll be sitting on a nice big cash flow every month and more equity in the property as well. So it's a twofold way that this thing comes about, and that's why you can see how it's so much more powerful than the stock market because of these two models. So why do people invest in real estate? Well, all kinds of reasons, but return on investment is a big one. You can, through the power of leverage, start with a little and create a lot. There's also tax write-offs, like depreciation, for example, but talk to your CPA about those. And you grow your net worth through that equity buildup. A lot of people really creatively do this for college education savings. That's something that we're doing for our 3 kids, because you can basically invest for 25, you can pay for college for 25 cents on the dollar. And with the way college education is going, you need that, you want to get all the help that you can. So here are some of the tax write-offs. I would say definitely just talk to your CPA, like it says here, because they do change every year. But these are some of the reasons that people really like the tax write-offs. Sorry. And then the proven systems. So there's lots of different ways that you can invest in a buy and hold strategy. There's lots of different kinds of properties, especially in this area in Greater Boston. You could go for a condo, you could go for a single family, you could do a multifamily, 2, 3, 4, or more units. And in a moment, Adriana is going to talk about the commercial lending side. But just to briefly go over some of the pros and cons. So with a condominium, you would be investing into a single unit. And the benefit is that you can probably get into a home at a lower purchase price than, you know, a single family or multifamily. And also the exterior maintenance is typically included in the HOA fee, the condo fee. So that can be good if, you know, especially if you're not in the area, at least the exterior maintenance is already being taken care of for you. And there's sometimes more amenities with a condo that can be attractive to tenants. The cons, of course, that you do have to factor in the HOA fees into your equation so that you make sure they're covered by the rent. And you only own a percentage of the building. You're a co-owner with other people, so that may be a disadvantage depending on how you look at it or what's important to you. You could be subject to assessments if something goes wrong, majorly wrong with the exterior of the building or the shared portion of the building. And less appreciation. I mean, I think that really depends on the market and what's happening in your hyperlocal market. So that would be something to talk to a realtor about, or somebody who's really familiar with the market dynamics. And a single family home, again, is just one unit. There's always more demand for single family homes, so it, you know, is arguably easier to resell because there's always a buyer for a single family home. And typically you're in a owner occupant, you know, kind of neighborhood. So that means that homes are well taken care of. There's better maintained neighborhoods. And again, maybe more appreciation. And of course the con is you just have one unit. So if your tenant moves out, you have 100% vacancy and there's just one income stream. So with a multifamily, with a two family, often those are in single family type of neighborhoods. So you're still in that, you're benefiting from being in a well-maintained environment. Other homes are being kept up. And a duplex, a two family, has less risk than like a fourplex or a bigger building, but you have more cash flow too than a single family home or a condo, and not as much risk of a complete vacancy. And then cons might be that you have slightly lower appreciation, although I would venture to say they're not really making more multifamilies. Builders usually focus on condos and singles. So there's usually a good demand for multifamilies, at least in our area here in Greater Boston. And maybe depending again on the neighborhood, maybe you're surrounded by more of tenant occupied properties. And then as you go up to 3, 4 units or more, you're looking at higher cash flow, and the numbers might work better when you're looking at covering the expenses, covering the mortgage, just because you do have that higher cash flow. You are so economies of scale. So if you have like a furnace issue, you know, or something like that, or you need to replace a furnace, you can maybe do all of them at once and save money, and less financial impact from vacancies, just because you can have more units. Cons, you have more tenants now. So you're going to have a little more maintenance to do. You're going to have more calls with tenant complaints. But, you know, I think a great property manager is worth their weight in gold. And if you, unless you are a contractor or a handyman and you like doing things like that, I would say definitely talk to a property manager, because they're going to help your building retain value. They're going to help you get great tenants, less turnover, better rents. So don't be scared of like the maintenance piece, because there are people that can help you with that. And you can still make money, maybe more. So less appreciation, again, I think that kind of depends on the market. But yes, single family homes are typically, they appreciate the most. But I think that the focus of the buy and hold strategy is not really the appreciation. That's just icing on the cake. The focus is the cash flow. So if you're able to find a property where you can make a cash flow, even if it's not huge at the beginning, that's still a good investment, because again, over time, like we just saw, those the cash flow will grow and the appreciation will happen too. So as far as systems, basically you need to kind of know what you're looking for. We talked about that, setting goals that are going to make what you want to happen. So being clear on that, knowing value, meaning just knowing your market and being savvy enough so that when you do see a deal or good opportunity, you're able to identify it. So that takes some legwork, or just getting out there and seeing homes, getting to know what's happening in the neighborhoods that you're interested in and where the opportunities are. And again, there are opportunities in every market. It's just kind of using your common sense and also partnering with a great team of a realtor and a lender, and people who invest already and can coach you, your mentors. They're going to all help you. Your team is so important and critical in this whole thing. So that's going to help you find the opportunity and identify it. And you need to have a good spreadsheet to run the numbers through. And I do have one. So if you need one, just let me know and I'll send it to you. And that way you can quickly run numbers and be able to pounce on that deal when you do find it. Being prepared and being ready is very, very important. Okay, so because money is obviously a big factor here, I want to touch on mortgages, and I'd like to turn it over to Adriana.
Awesome, thank you. And thank you for sharing such great information. I think I learned some stuff myself, so thank you, Carey, some great information. Awesome. I'm gonna go ahead and share my screen, and my objective today is just to really touch upon of how a bank analyzes and reviews commercial transactions that come our way from an investment standpoint. So anything like, investment properties, and really just taking a look of how the bank reviews it. So let me just go ahead and share my screen. Awesome. Can you see my screen okay?
Yes.
Awesome. Okay, so really what is considered and defines commercial real estate? When can you get a commercial real estate loan? And really what that comes to is anything that's really considered an investment property. Now, there's some instances that you may be able to live in the property if it's over a certain amount of units, but really anything that you're not going to live in and something that's going to generate income. So residential single families, this is uncommon, but we do definitely see that. Family homes, so multifamilies, which is, very popular nowadays, 3, 4, 5 families, even 2 families, condos, townhouses, and et cetera. Commercial strip malls, medical buildings, hotels, mixed use residential, which would be a storefront on the bottom, and then residential units up top. When you find a property like that, usually you'll need to go with a commercial mortgage instead of residential, just because it's deeded commercial. And then lastly is industrial, your typical warehouses, distribution centers, storage facilities. Awesome. So again, just to touch on what constitutes as an investment real estate loan would be the property being non-occupied or the property being placed in an LLC. The property being in an LLC in a trust, you can't get a residential mortgage. So you'll find a lot of investors or a lot of investors typically will go to the commercial route. And this is really projected for long-term growth. So if you know you're going to be continuously buying properties, it's always great to talk to your accountant, talk to your attorneys to see what is most beneficial for you. Is to start out in an LLC and continues to grow that. An owner-occupied property, but has to be greater than 4 units. And essentially what this means is how the bank will look at it from an investment standpoint. Say if it's a 6-unit property, we're only going to take in consideration the 5 rental units income. So we're going to subtract your rental income. So we want to make sure that the property is strong without including your rental income. Lack of W-2 income or history of income, as loans are primarily based on the property's performance. So we look at you as a guarantor, absolutely, but we really focus on the property and what is that bringing in from additional, income. So we're able to calculate anything that's left over from the property. So say if you have, $90,000 of rental income, anything that's left over after the expenses, we're able to add that back into your income, which helps in a lot of situations where there may not be historically consistent W-2 income. We're able to utilize that. And also debt to income ratio. Residential lenders will typically really focus on the debt to income ratio. And with commercial, we really focus again on the property and what that property is going to bring in for income. And then lastly, but passing your residential loan limit, you're only allowed to hold a certain amount of residential loans personally in your name. So there'll come a point as you grow as an investor that you'll need to eventually get a commercial real estate loan. So understanding the process now and knowing your options will only be beneficial as you grow and to become an investor. So why seek financing? There's many reasons why you would seek financing for a commercial real estate loan. Most of them are purchases. Some will be cashed out equity. And that's kind of what Carey talked about, is leveraging your current assets to create more assets. So utilizing an investment property that you already have, pulling out the equity to purchase more. So continuing to grow that portfolio. Also a restructure of properties by putting it into an LLC or a realty trust. I get a lot of early on investors that usually purchase the property in their name, and then they'll come to me and say, hey, I want to put it into an LLC or a trust. And we'll typically do that simultaneously with closing. It's not something that the LLC has to be created before you talk to a lender, but as we do the refinance, that will happen simultaneously with the closing and with the attorneys. And sometimes, mostly reducing your interest rate and your monthly payments. Also, debt consolidation is a big one as well. So a lot of many great reasons. And I'm just going to touch on this very briefly of what the banks look for. So we usually focus everything on the 5 C's of credit. Essentially, what the C stand for is character, capacity, capital, collateral, and conditions. So what's your experience in managing properties? What is your capability of paying the debt back to the bank? And how many holistically properties do you have in your portfolio? And essentially, how do you manage those? So the more prepared you are and the more plan that you have when you go see a lender, it's only helpful as you move forward with the process. Capacity. Again, this is the ability to repay the loan if the cash flow is tight, or you have a tenant move out, and those loan payments are obviously still going to continue to be due. So what do you have, to help if a tenant moves out in that situation? Again, capital. What do you have for liquidity? What reserves do you have? Just like I said before, if something breaks or if a tenant moves out, what do you have that you continue to pay the loan back? And condition. The bank is really going to look at it as a average condition property. So it can't be completely run down. It doesn't have to be brand new. And if there is construction, obviously that's a different type of loan that you can potentially build in. But really, we're going to look for average condition property because we want our collateral to be average or in good standing. We don't want a building that's broken down or run down. And it's also very helpful to understand What is the condition of the property? When was the roof repaired? When was the major appliances fixed or replaced? Because that's going to be helpful to explain as it goes through the underwriting process and to the appraiser. And then collateral. These are the assets, obviously, that are used to secure the loan. What is the LTV? Is it acceptable? Helpful items to understand, and I think this is very instrumental to, as Carey said, to have a really good agent that can understand how to analyze a deal. Because when you're looking, you can look at a million different properties, but you really want to make sure it makes sense to you and your financial needs. And at the end of the day, is it bringing in a cash flow that you feel comfortable with and the bank feel comfortable with? So having an agent that can analyze the deal with you and weigh the pros and cons is instrumental when growing your real estate portfolio. So a couple items to understand as you look at a property or be able to ask up front is, what's the current rent roll? What is it bringing in income? What is the expenses of the property? What has the expenses been for the last 3 years? Has there been any major repairs? What other leases in place? What kind of leases are they? Are they triple net? What are the terms? Are they below market? Is there an ability to increase those, or is there increases built in those loans? So understanding the leases is very, very helpful. And again, just to touch on the property condition, which is very important, is to make sure that the property condition is at least an average condition. That's going to be instrumental with the bank. Sometimes we'll have a loan get approved, and then we'll get all the way to the appraisal, and the condition or something may be wrong, and it does delay a lot of things. So just understanding the condition up front and kind of doing your overall observation is very important. And what has been collected for security deposits and such? So do you have first and last month's rent? Do you have security deposits? That's going to be important to know for your reserve, and also too from the seller, where is that being held? How is that going to be transferred? So loan structures are a little different than residential. With commercial, loan terms could be up to 15 years, but typically you'll see a 10-year term. And within those terms, there is rate resets. So either 5, 7, or 10-year rate resets. Depending on the lender, you have the option for a 10-year fix or even a 15-year fix. But the initial rate, the higher you obviously fix it, the higher the rate will be. So it all depends on, again, your financial picture and what's going to benefit you. Rates are based on a spread over an index, and they're typically set 3 days before closing. A little different than residential, when you're typically able to lock in at the point of approval. And the amortizations can vary from 20 to 25 years. We mostly see a 25-year amortization schedule. So just to go over some recent funding examples that I have done, recently was an investment property refinance in North Andover. The borrower paid out of pocket for a lot of renovations, and he wanted to pull that cash out to pay himself back. And he also wanted to put a property in the trust at the same time. So we were able to do that, pull some cash out, reduce his rate, and obtain a significant amount of liquidity and equity out of that property that he'll now be able to continue to reinvest. This is a purchase. I also did a purchase of an investment property as a 6-unit in Worcester, and a purchase of a 3-family in Boston. The borrower in this one, this is a great story. The borrower used their primary residence to take out a HELOC. So they used their current assets to take out a HELOC, and they used that HELOC for a down payment for an investment purchase. So this is really important, as Carey talked about, is to leverage your current assets to create more assets. So what do you have currently that you can leverage to continue to grow that portfolio? And again, a purchase of 3 investment properties in Dorchester. We utilized a blanket mortgage in this case, and it was through a 1031 exchange. So the borrower was selling one of his properties, and he wanted to, purchase multiple, and that was held in a 1031 exchange for tax reasons. That's really all I had to go over. But again, this is my contact information. I'm happy to answer any questions and be a resource for anything that you guys may have from on the commercial real estate lending side.
Thank you so much, Adriana. Thank you. Awesome. Yeah, so definitely agree wholeheartedly with Adriana's saying that it's good to leverage your assets to create more assets. I mean, that's exactly what banks do with your money. They use your money to create wealth for themselves. So why not do the same for yourself, right? You can take that equity that's just sitting there and leverage it, like she was saying, as a down payment for another property, or two or three. So that's a really good strategy. And whether you're just, I don't know if you're starting out or growing your portfolio, but there's always ways to break into the market. And if you're thinking, well, I haven't got the down payment yet, let's talk, because there might be ways to even borrow from a retirement fund, or house hack. That's something I talk about in my book, is where you live in one unit and rent out another. Makes it a lot easier and accessible to get your investing journey started. And then, as Adriana was saying, you can build upon that first purchase to create even more wealth for yourself. So where there's a will, there's a way. And as I mentioned before, property management companies are out there, and I have some really good ones I can refer you to if that's something that you need on your team. I know a great one locally that handles even smaller properties, like a condo or a 2-family or 3-family. So if you're not eager to self-manage your own properties, this is a resource that I have in my network. So next steps, congratulations on taking this step. First of all, this is so good to just keep in the mindset of an investor, keep learning, and make sure that you keep your head in the game, because that's how you're going to be able to move forward. I would definitely recommend picking up a copy of the book here, Millionaire Real Estate Investor, to have in your collection to refer back to, and please pick up a copy of my book. You can have it all with real estate, and connect with me, connect with Adriana, and just get your ducks in a row, because again, it's all about being prepared in real estate. And once you have your team in place, that's a huge part of it. And then just keep learning and educating yourself. Bigger Pockets podcast is one that both Adriana and I listen to. It's a really nice resource to stay inspired and learning. So questions. I see a couple in the chat. Cami says, it seems very difficult to get sellers to accept offers today with a limited inventory. Any recommendations on how to put in an offer that will get accepted, even though you need financing? Yeah, no, it's true. It's a tight market. So there are usually competitive bidding wars on the good properties. Well, I was just mentioning to Adriana before the call, I have access to off-market properties through my agent networks and my database. So that's one way of avoiding a bidding war, is if you can locate an off-market property. That way you're not in competition. But as far as creating an offer, it depends on the buyer's situation and obviously the property. I mean, you can drop contingencies and have a clean offer. That's one way of doing it. Or like Adriana was talking about before, I know a lot of buyers right now are using their HELOCs, their home equity line of credit, to make cash purchases. So, and then they just refinance the property later. So if that's an option, that might be one way to go. And hopefully this market will loosen up a bit. We're going into spring, so we should start seeing some inventory coming on, some fresh inventory, and that hopefully will make it a little less competitive. I also, just one thing I'm getting into now is international investing. I actually just sold a property in Tulum, Mexico, and I've also invested there myself. So it's a lot cheaper there. And the Airbnb route, the short-term rental vacation route, is pretty intriguing, especially since COVID and people are working remotely for good ROI. So, when we talk and, get together, we can go over lots of different opportunities that I see in today's market. Yvonne says, I was late, so sorry. I may have missed this answer, but how do residential mortgage rates vary from commercial mortgage rates? And where do your crystal balls foresee both types of rates going this year? That's a great question, Yvonne. Adriana is probably better equipped to answer that.
Yeah, I could take this one. So rates definitely have increased compared to last year. No doubt about that. Residential rates sometimes will be a little lower, but most recently they've been pretty much in sync, to be honest with you. Residential investment rates are always higher. Your primary residence to buy your first home, that rate's going to be lower. But on the investment side for residential, the rates are really in tune with a commercial real estate rates. They may be significantly on the residential side a little bit lower, but it really is weighing the pros and cons. You know, is it better for you to put it in an LLC so you continue to grow that and pay a little bit of a higher rate? So it really all depends on your personal financial picture. And again, like mentioned, sometimes debt to income becomes a problem. So you're not able to go residential and you're able to go commercial. So paying the extra little rate essentially gets you the property, and that's ultimately what the goal is.
And my crystal ball is telling me that rates are going to probably go up, though not dramatically, but they're edging up. Is that what you think too, Adriana?
Yeah, I think you'll see a couple more increases within the rate this year. I don't think drastically, like 1% and 2%. I think that you'll see them kind of slightly over time.
Yeah. And depending on the price point, even a small increase can be significant over the term of the loan. So another reason to get going sooner and lock in a good low rate.
Yeah, absolutely. And I think it's important too, to when you're running your cash flow and you're sitting down with your lender and your agent, to project the rate a little higher, just in case, because like we said in commercial, we only fix 3 days prior to closing. So having a rate that's a little leverage and higher will only help you long term, because at the end of the day, if the rate's lower, it's just going to add more cash flow into your pocket. So I always like to overestimate with my clients, and we'll fall lower, which will help to ultimately more cash flow in your pocket.
Yeah, that's a good way to go. Thank you so much. Any other questions for us? I would love to connect with anyone directly too, because obviously we can get into it a little more specifically one-on-one. So feel free to reach out. Here's my email and my phone number. We can do a Zoom or chat, whatever works. So I'll actually send you a copy of the recording too with both of our information, and definitely encourage you to talk to us, because I think even if you're not ready, it's great to have the conversation early and make sure that you're prepared and can do whatever you can do now to get there sooner. So thank you so much for coming today, and thank you, Adriana, for your expertise. It's been great.
Thank you for having me.
Absolutely. Have a great day, everybody, and let's go invest.